we're seeing not just a lot of gold flow to the US in the last few months, like over 2,000 tons, but a lot of silver also is flowing. I think the bullion banks are, yeah, they're trying desperately, and I'm sure they keep track of the gold and silver bugs and the silver squeeze, and I'm sure they've done their darndest today to keep the paper price down on silver squeeze, but I think it's just delaying the inevitable. Yeah, eventually things like that are not sustainable, they fail, and when people want their physical.
Recent discussions surrounding the silver market have reignited concerns over the potential for a silver squeeze, a scenario in which soaring demand for physical silver leads to significant price increases due to supply shortages. Mario Innecco has drawn attention to the growing disparity between paper silver markets, such as futures contracts and ETFs, and the actual physical silver available. Innecco stresses that these paper markets, which are heavily influenced by short positions, may not reflect the true value of silver, and the manipulation of these markets is becoming increasingly apparent. As a result, more investors are looking to the physical market for silver, which could eventually lead to a major price surge if the short positions need to be covered. According to Innecco, the growing frustration among silver investors, particularly as gold prices break all-time highs, is compounded by the fact that silver remains stagnant in the mid-30s, well below its previous all-time high of $50. This ongoing frustration is a direct result of the manipulation and speculative activities in the silver market that continue to hold back its true potential. The silver market faces a significant structural deficit, with demand consistently exceeding supply. This shortage is exacerbated by the growing industrial demand, particularly from sectors like solar energy and electric vehicles, which rely heavily on silver. Mario Innecco highlights that this supply gap is further intensified by manipulating silver prices, driven by excessive short positions and paper contracts. However, as more investors move away from paper assets and focus on physical silver, Innecco predicts that the market may experience a major correction. This shift could increase silver prices as the supply-demand imbalance becomes more pronounced. Innecco stresses the importance of holding physical silver as a safeguard against the risks of paper markets. Unlike silver ETFs or futures contracts, which are vulnerable to manipulation and cash settlements, physical silver offers a more secure and reliable store of value. Given the mounting pressure on the market, Innecco believes that those who invest in physical silver now will be well positioned for significant future gains as the market adjusts to the shifting supply and demand dynamics. We present the clips of Mario's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I was looking past weekend I think on the live stream with Clive, and silver actually up until Friday, year to date, is outperforming gold by 1% or 2%. So I think the reason people are frustrated is because gold is making all-time highs, like there's no tomorrow, and silver is still stuck here in the mid 30s or so, and the all-time high is 50. But as I said, patience I think is needed, and stop buying ETFs, buy the physical, and there's no excuse. In my opinion, I've never bought a silver ETF, and if you remember, I mean, I've spoken in the past about how all the gold prices in different currencies have been going up, and how the Japanese yen has been leading this race down to zero. But we're also seeing now that in other currencies, silver is actually trading to new all-time highs, like with the Canadian dollar, with the Aussie dollar, they're trading like above 50. So I think yeah, that's what's going to happen. And I think the fundamentals for silver are still really good. 5 years of deficit in the silver market, i.e., there's more demand than silver that's produced or recycled. And we're seeing not just a lot of gold flow to the US in the last few months, like over 2,000 tons, but a lot of silver also is flowing. And who's to say that another billionaire or another two or three is not going to emulate David Bateman? I think it's very possible. And yeah, I think the bullion banks are. Yeah, they're trying desperately, and I'm sure they keep track of the gold and silver bugs and the silver squeeze, and I'm sure they've done their darndest today to keep the paper price down on silver squeeze, but I think it's just delaying the inevitable. Yeah, eventually things like that are not sustainable, they fail. And when people want their physical, their argument is that they hedge it on the LBMA. And they buy these OTC promissory notes or forwards, which forwards are just another future. And we've seen that in the LBMA. These OTC promissory note contracts are just they're not really physical. If they were physical, the Bank of England wouldn't have a delay of like a month to 2 months in delivering gold. And yeah, so when they come out and say, "Oh, you guys are crazy," these massive shorts are covered because we're long in the LBMA, but they're not really long physical, and that's the problem. But eventually, it will, uh, it will come out. People are waking up to it, and I think Eric Young, aka King Kong 9888, he's done a really good job of explaining how they use the EFP mechanism to execute this scam of pretending that paper is physical. And EFP stands for exchange for physical, but it's all settled cash. So basically, the LBMA is like a bucket shop. Bucket shop. There are kinds of brokerages in the early 1900s where you could bet on the price. You weren't buying any stocks or selling any stocks, and I think that's what the LBMA is. COMEX, to some extent, is also a bucket shop, but it's not as leveraged as the LBMA because there's no regulation. The LBMA, the banks that trade in London, they're not regulated by the Bank of England. They're like self-regulated, so they leverage many, many times over. While COMEX in the U.S., the leverage is less. It's about, I don't know, COMEX, you have to put 10% down, so it's not as much as leveraged.
The gold market is experiencing an unstoppable rally, reaching another significant milestone in less than 2 weeks after breaking above $3,000 an ounce. As prices continue to rise, analysts adjust their forecasts, with some even abandoning their predictions due to the unpredictability of the market. Last week, analysts from Goldman Sachs, Societe Generale, and Bank of America revised their outlook, setting $3,300 as the next major target for gold by the end of the year. As the market starts the week with gold futures trading at $3,160 per ounce, up 1.47% on the day, the price is now less than 4% away from the newly revised targets. This bullish trend has been fueled by growing fears of a global trade war, particularly as President Donald Trump is expected to implement new import tariffs, prompting capital to flow away from U.S. equities. This volatile economic environment is further exacerbated by a deepening erosion of trust in Western political leaders and central banks, which Innecco points out as a critical factor in the growing demand for gold. As global economic instability mounts, particularly in Europe, confidence in fiat currencies like the US dollar, euro, and pound is rapidly deteriorating. Innecco warns that this loss of faith in political institutions and currency systems could be the precursor to hyperinflation, where traditional assets lose value and investors flock to gold as a safe haven.
No real news, but I've seen someone post recently. I don't remember who it was, but If you look back when gold made its big runs like 79 to 1980, there's a huge crisis then, a recession. Paul Volcker had to let rates go to 15%. So it was forecasting some trouble ahead. For some reason, gold does that. And back in the 2000s, yes, gold was in a bull market from '02 to like 2011, but it really started picking up like in 2007 all the way to March 2008 when we topped at 1,000, and then we had the subprime crisis. And then we had a big move up in 2011, and that forecast the European sovereign debt crisis. So I think what's going on now, there's so much out there that is, how can I say, pointing. Well, there's some indicators that are worrying, like the Japanese government bond market. The yields there are going up very quickly. The Japanese yen is strengthening. U.S. Treasury yields are still really sticky. They're not really going down as much as people expect them to. What else? The stock market seems to have topped. We're down on all the three indices year to date. So yeah, I mean, as for today, it's just a continuation of what we've been seeing. So yeah, I think gold is pointing to trouble ahead, but it could also be pointing to something that I've been like warning about for years since I started this channel, and that's hyperinflation. And I think it could happen, yeah, very quickly. And hyperinflation is not really anything to do with cost push inflation. It's more to do with confidence in the currency. And we have to admit, I think, that confidence in the political and the leaders, central bankers of the West is at rock bottom, I would say. Maybe not in the US, but it's still very divided. Here in Europe, they're using lawfare like they tried on Trump, and they've banned the Romanian guy who won the first round last year, presidential election. They've just banned Martin Le Pen. Is it Martine? Oh, yeah, Le Pen from running for president in 2027. She will appeal, but it all seems to be falling apart. The social, economic, political environment. And when that happens, Elijah, trust in the currency evaporates because the currency is issued by the establishment. So people might want to trade gold, but I'm going to hold on to it because I don't want to trade gold for collapsing fiat currencies. And that includes the dollar, the euro, the pound, all of them.
The gold market continues to soar, with prices reaching new heights and showing no signs of slowing down. While this bullish momentum is largely driven by news surrounding trade tensions and geopolitical uncertainty, a short-term correction is still possible. The recent increase in Bank of America's gold price forecasts underscores the growing belief that the precious metal will continue to thrive amid ongoing uncertainty, particularly as U.S. trade policies remain unpredictable. Bank of America's revised predictions now place gold at $3,063 per ounce for 2025 and $3,350 for 2026, a notable upward adjustment from their previous outlook. However, they caution that several factors, including U.S. fiscal consolidation and reduced geopolitical risks, could dampen gold's momentum in the long run. As the global political landscape shifts and the possibility of more targeted tariffs arises, the future trajectory of gold remains tied to the evolving economic and political environment, which could either drive prices higher or trigger a much-needed correction. That's it for today. Share your thoughts on Mario's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.